Hello and welcome to the Weekly Outlook at xm.com. I'm Maria Pachordes, and joining me is lead investment analyst Rafi Boyadjian. We'll be reviewing the week ahead. So Rafi, let's start with the Eurozone. When the Flash PMI numbers for March come out on Thursday, investors will get a clearer sense of just how much the current geopolitical turmoil is affecting economic activity. What should we expect from that data, and how is it likely to impact the euro?
Well, Maria, there is quite a bit of talk that the Ukraine crisis will lead to a new recession in the euro area. At the very least, I think pretty much the consensus is that the Eurozone economy will suffer a significant slowdown. And we could see the first signs of that potentially in the March Flash PMIs. If the survey data shows us that businesses are becoming less confident about the outlook, that the price pressures are becoming even more of a burden on businesses, and even perhaps they're seeing less demand for their goods and services, then that could spark a bit of a panic about the fact that we are possibly headed towards a sharp slowdown in the Eurozone economy. And we already know that Europe is most at risk from a recession, from the sanctions against Russia, and of course the energy crisis, which has been exacerbated by the war. So should we get worse than expected numbers, that could take the shine out of the euro's recent bounce back against the US dollar, as investors might pare back their expectations of an early rate hike by the ECB.
Okay, moving over to the Swiss National Bank now. Policymakers will meet on Thursday. What are we expecting to hear from the SNB, and how might the Swiss franc be affected?
Well, we're not really expecting any changes, even though if you look at interest rate futures, investors have priced in rate increases later this year. In fact, they see the SNB getting out of negative interest rates by the first quarter of next year. We haven't had any such signals at all from SNB policymakers. Markets could end up being wrong about this. The S&P might really maintain its current policy for the foreseeable future. That's because even though we are seeing inflation tick higher in Switzerland, it's not expected to peak that much, at least nowhere near as high as we're seeing in other countries. That's because Switzerland relies mostly on hydroelectric and nuclear power for its energy needs, doesn't trade that much with Russia, so the impact from this crisis will be rather limited. The bigger concern for the SNB is in fact the exchange rate. We already saw the Swiss franc jump in currency markets on the back of the safe haven demand. We saw the euro fall below parity against the franc. Now we did likely see a bit of intervention. We haven't had confirmation from the SNB. Most likely they did intervene a little bit to keep down the franc. But they will nevertheless reiterate the fact that they stand ready to do more should it be necessary. So that's pretty much going to be the same message likely that we're going to get on Thursday.
We'll also get Flash PMI prints for March out of the UK on Thursday, in addition to CPI and retail sales figures for February during the week. And on Wednesday, Chancellor Rishi Sunak will make his spring budget statement. How important will the data be, and are we likely to hear anything new from the Chancellor?
Well, like in the Eurozone, we could see a slight dip in the PMIs for March. We're also expecting a further jump in inflation. Forecasts are it's going to rise to 5.8% in February. However, after this week's Bank of England meeting, a stronger than expected increase in inflation might not really do much for the pound. So not only were there no MPC members voting for a 50 basis points rate hike on Thursday, one MPC member actually wanted to keep rates on hold. So that's quite a significant shift from the last meeting where the dissenters were really those opting for a 50 basis points rather than 25 basis points increase. So this suggests the bank is getting more nervous about the growth outlook due to the Ukraine war and the worsening energy crisis. It is possible, though, that Finance Minister Rishi Sunak might come to the rescue next week if he announces new measures to support households and businesses to cope with the surge in energy bills. We know he's under a lot of pressure to do something about it. He hasn't really hinted, though, anything that what he's planning to do, if anything at all. So should we get any announcement, that's probably going to come as a bit of a surprise and attract a lot of attention. And we could see the pound getting a bit of a lift.
And finally, over in the US, Flash PMIs are also due out on Thursday. However, for the dollar, perhaps the most important news will be the headlines from the Ukraine.
So although we do have quite a bit of data coming up out of the US, there's very few highlights for investors, mainly durable goods orders and the Flash PMIs, like you mentioned. Now, the Flash PMIs could be interesting because these, of course, are more survey-based data, is considered to be more forward-looking than the other data. So investors will be looking for clues that perhaps price pressures in the US are easing. Now, I doubt we're going to see any slowdown due to the Ukraine war in the US data, like in Europe, at least not just yet. But any surprises in these components, such as the price components, the employment components, and the orders components, these could spark some reaction in the dollar. Overall, though, the dollar will mainly be taking its cues from the war headlines. Signs of progress in the peace talks between Russia and Ukraine diverted some flows out of safe havens like the dollar into risky assets over the last week. So if we get more substantial progress in these negotiations over the coming days, the greenback, the yen and the franc could pull back even more. On the other hand, should the talks falter, that could revive safe haven flows and we could see currencies like the euro and pound coming under heavy pressure against the dollar.
Rafi, thanks so much. And thanks for joining us at xm.com for this weekly outlook.